So welcome here, folks. Pleasure to see you today or this evening, wherever you may be in the world. Today, I am thrilled to introduce to you my guest host, Dr. Andrew Unterweger. Today, we'll be talking about owning or investing Australian real estate when in the United States, what the expat buyer needs to know. I'm actually very excited to introduce Dr. Unterweger. Dr. Unterweger happens to be one of the few financial advisors who's a medical doctor. He has a long and storied history in the world of financial services. He's founded many different companies, and he's done a whole lot of different things. He works out of Singapore, provides a property advocacy service, which is a term not familiar, I think, to many Americans. So I'll be looking forward to Andrew to define that term. Andrew's also had experience in venture capital, and as I mentioned, a broad range of different financial services companies as well. Today, we'll be hearing from him, representing Wise Guru, the Wise Guru entity in particular, to do with what the expat buyer needs to know, as well as providing an update on what's going on in the Australian real estate market. So with that, welcome, Dr. Andrew Unterweger.
Thank you very much for your introduction, Ashley, and I'm very pleased to be here, and hopefully we'll be able to share a few interesting insights with everyone that's on the call.
Indeed, indeed. Just wanted to remind everyone of our YouTube channel. So all of our presentations, including today's presentation, will be posted up there. You can find last month's presentation, The Issues Affecting the Children of the Globally Mobile, up there as well. An important disclosure to mention here that today's presentation does not constitute personal financial, tax or investment advice. This is of a general nature. You'd be well advised to speak with your own international cross-border financial advisor or tax accountant or property advocate as the situation may be appropriate. A little bit about me before we get into today's presentation. I'm a tri-citizen born in the UK, raised in Australia to an American mother. So I've been a tri-citizen from birth. So these issues, the issues of cross-border financial planning, have really been with me for as long as I've been around. I moved to the US in 2005. I've been a financial advisor now for over a dozen years. I'm the founder and principal of Arete Wealth Strategist. I also speak at a number of financial planning conferences quite regularly. I'm also the founder of the Global Financial Planning Institute. And I got into this. I think that's maybe of interest to folks. I got into this because when I moved to the US in 2005, I figured there had to be a financial advisor that could understand these cross-border implications. Turned out there wasn't. And so it took a few years of self-education, of networking, before I felt that I was in a position to offer this to others. And so that's where we are today, some 17 years later. And that's who we work with. Just a couple examples here of the kinds of clients that we work with, the sorts of goals that they have, and the results that we've been able to attain for them. With that all said, let's move on to the outline for today's presentation. So I've already introduced Dr. Andrew Unterweger. We're going to go through and just have a conversation about various things, about buying real estate as an Australian resident versus a non-resident. It's important for Aussies to know there's a distinction in the tax treatment as to whether you're an Australian resident or non-resident. Different capital gains rates apply, different ordinary income earning rates apply. There's also some other things that come up with property as well, which Dr. Andrew Unterweger will address. We'll ask about what tips he has in addressing those particular resident versus non-resident issues. Working with Aussies seeking to purchase property in Australia, what would you do in such a situation? What advice would you have for them? What are the advantages of using a service such as realestate.com.au or domain.com.au over your services? And are they even applicable? Are you in the same market, or is it something different entirely? Advice on property management and taxes from abroad, process of obtaining a mortgage from abroad, and we'll look forward to hearing a good overview, about 25 minutes or so overview of the Australian property market. So with that, let me swap slide decks over to here. And we can take it away. So are you able to? Okay, you can see that. Wonderful.
I can see that. Thank you very much, Ashley. Look, it's great to be able to have a bit of a conversation about you, because I've found that there's a certain amount of naivety that exists, or perhaps lack of information, more importantly, where we have so many Australian expats living around the world, and they don't really understand some of the fundamental differences and similarities that exist between purchasing property from abroad or purchasing it within Australia. So just a little bit of very quick background. I'm an ex-medico and originally started our advisory business over 30 years ago to look after my peers, so other medicos that moved into the other professions, and then into especially the banking and finance sector, which gradually developed our expat client base. And it doesn't matter whether you're a surgeon or a banker or whatever, we found the demographics for our clients are pretty similar. They're all very time poor. They wanted to include real estate as part of their overall asset portfolio. And they basically wanted someone to assist them with a kind of end-to-end solution, I suppose, because it's very difficult in this sphere of the market. It's not like other mark-to-market assets such as equities or bonds where you can look it up at any time of the day. So they needed assistance with this whole process. And that's when we gradually developed our concierge service, which we have now. And if people actually seek our services from a property viewpoint, we charge them $4,950, that's Singapore dollars, upon settlement of a property. So the entities there, as you see, Aussie Property Guru, which is the Australian real estate business, Aussie Loan Guru, which is the lending business, Wise Guru is the international consulting business that specializes helping Australian expats, and Unicorn Partners is the advisory firm in Australia. So without dwelling on that too much further, let's move on.
Indeed. I can't help but notice you're fond of that guru word in this. It's common to almost all those business names.
It just came through. Yeah, I know. Well, there you go. I mean, the knot of wisdom. Usually you find that only happens over time, and experience costs you a lot of money. So look, Ashley, and you can ask me some questions as we go through. Obviously, we'll be having a discussion, but these are some of the most common questions that we're being asked at the moment, and a lot of it revolves, as you might imagine, around inflation or the impacts of inflation, interest rates in particular. Obviously, how central banks are trying to control inflation. How's that going to impact my property expenses, my rental income? How will that impact the actual price of my property assets? Then there are some more, I suppose, relevant questions simply to the property markets, and that is, it's a supply and demand situation, because housing is not necessarily a speculative asset. People actually utilize it for shelter. So, people need to live somewhere if we're talking about residential property. And so people are asking us, well, we've heard a lot about the influx of overseas migrants coming to Australia since the borders opened on the 15th of December this year. So we'll look at the impacts of that, because they're different in different places. Also, I'm sure a lot of people are still working from home, or a lot of large employers have decided that a hybrid situation may well exist into the future, into the long-term future. How will that impact supply and demand in different areas? And very importantly, how do we navigate this current array of variable and fixed interest rates? And as you're aware, Ashley, I mean, if you're a client of ours, we can actually provide loans to expats, Australian expats, so earning foreign income, up to 85% loan-to-value ratio without having to pay mortgage insurance. So I don't know of anyone else that's able to achieve that. So we try and give our clients any adjunct benefits that we can derive through leverage with manufacturers.
I just want to push on that a little bit. And so you're able to do that because of the length of history you've got with your lenders and also the existing book of business. That's how you're able to get a better than retail experience for your clients.
Yeah.
That's what you're saying.
Yeah, that's right. I mean, it's not just because we're really nice people, even if I'd like to think that, but it is, I suppose, due to that longevity of having built up a book that shows the bank that's actually a good credit risk.
Yeah. Okay. Well, that's fantastic. Yeah. And it's at this point I need to mention I'm a fee-only advisor, and so we actually refund any fee that would otherwise be paid directly to our clients. So that's how we operate.
Yeah, and you know, lucky for your clients, it's a very good situation to have.
Here we are with that next slide of yours.
Yeah, so you know, I often get asked around the world, look, what's happening in the Aussie property market? And that's when I say, well, there is no Aussie property market because it is such a large continent. So what's happening in Darwin or Hobart or Perth or Melbourne, Sydney or Brisbane, as we sit here today and at any other time, it's generally very different because the various states have different economies, where some of them, like say WA and the Northern Territory, are very much focused on the mining industries, and others are not. So it's different in all those areas, and also the supply and demand factors are different in those various states and in the various capital city markets and the larger regional markets. And I'm particularly referring to, I guess, the sort of lifestyle markets such as, you know, the Sunshine Coast, the Gold Coast, Newcastle, Wollongong in New South Wales, Geelong in Victoria, and so on.
Mm-hmm.
Yeah.
Mm-hmm.
So what else do we consider? A lot of things on that slide, and one of the interesting ones here is you know, what is happening with migration. We've seen a massive rebound in net overseas migration since the beginning of the year, and that's in you know, in permanent long-term visitors, in short-term visitors. Interesting thing is most of the short-term visitors come from New Zealand. There's another issue there about the New Zealand market, but you know, this situation where immigration is improving strongly has another impact, because most of these migrants are generally younger, quite well educated, and are looking forward to the rest of their lives. So they're actually going to contribute to the natural increase, or the organic increase, births over deaths of population as well. And it's something, you know, we need to bear in mind, because both of those factors will have an impact. One perhaps shorter term and more dynamic, but the other one certainly also dynamic over the long period of time. So you can see here, you know, if we look at the projections of, pardon me, net migration increases, it's pretty strong at the moment. And these numbers, we look at them, a lot of these indicators are lagging indicators. So they come through from ABS and other government agencies, and they might be printed every, you know, 6 months or 3 months or 12 months. But all of the numbers that we're seeing on an ongoing basis are continuing to point to this upward trend. And it's something that I think is really important for an economy like Australia, because one of the biggest, I guess, constraints there is labour, and that's going to potentially be one of the sort of stickier problems that the Reserve Bank has to face in relation to how inflation is tracking, and it's being caused by these supply bottlenecks due to lack of labour. So the second very important issue, because Australia is so large, is that there's a shift, generally speaking, prior to the pandemic, of about 400,000 people moving between various states and territories. Obviously, during the pandemic, that wasn't the case. But if we have a look at it now, you look at interstate migration, and you can see there, New South Wales, it's mainly Sydney, seeing that outflow, and in Victoria, it's mainly Melbourne, and the inflow going into southeast Queensland and Perth. And the reasons for that are, you know, many and varied, but this was actually a trend that was occurring before the pandemic. And it was driven largely by commercial reasons. So someone in Sydney, for example, could sell their home and buy something for, less than half the price in, say, Brisbane, and have a better quality of life there. So that's what was happening. Now it's being driven also by this work from home effect, where we've seen certainly many people say, well, look, we can live somewhere like the Gold Coast, let's say, or the Sunshine Coast, and travel to Sydney or Melbourne via airplanes, and spend 3 days here and 4 days there, or vice versa. So I think that's actually going to potentially continue to some extent, certainly for the long term.
Mm-hmm. Mm-hmm.
So this is something that's probably of great value if we look at this, because this has been the first time that national home values have shown an annual decline, and they're down 0.9% for the 12-month period to the end of October. So, when you compare that with other asset classes, that's not, that's a very mediocre, or I suppose, a very light touch decline at this point in time. Worth bearing in mind that if you look at the quarterly decline, it's minus 4.1%. And Sydney from peak to trough, peak was earlier this year, is down nearly 11%. Brisbane 8%, Melbourne same. So, you've got to look at this, and certainly dwelling values, I believe, will decline over the course of next year. That will depend on which area you're in as to the extent of that. And I think from the numbers we see these on a monthly basis, some of them weekly actually, that the pace of growth, pace of decline is slowing. So particularly pleasing, I think, for some of our clients and people in general who have property in Sydney, which was the first cab off the rank. It's slowing up there. And I suppose from the other side of things, we have many clients who are actually looking to buy things, particularly in Sydney, because they couldn't over the last 2 years due to the frenetic pace of the market there and then getting outbid. So I think the next 6 to 9 months will probably provide a pretty good opportunity for people to try and get into that market. But the issue, of course, is that you're going to have a lack of supply, because unless you need to sell in this market, then many vendors will say, well, I won't sell, and I'll simply wait, for the cyclicality to return and look at it then. So we're finding a lot of clients still having great difficulty in trying to obtain the property that they want. And that's generally, people who are looking for something to live in. So whether they be first home buyers or right sizes, as we call them, so people who might be upsizing or downsizing, it's still a bit of an issue.
Okay, and I was just thinking to myself, why don't we go through your update and then we'll return to the questions at the outset when you're finished with your update.
Sure. Okay. Well, let's continue on with if you like, you can continue with the slides. So there's the supply and demand situation. That's very important with any asset, but certainly with property. I think at the moment the construction industry faces some pretty severe headwinds due to increase in both input goods and mainly also with labour costs and finding people to actually do the building. So as we can see there, on the supply side, it's well below the decade average. In certain areas, it's far leaner than that. And I think that'll continue. So if you want to go through some of these things a little more quickly, we can, Ash. Let's go on to the next one. Important because whilst history may not repeat itself, it often rhymes. And if we have a look at these peak to trough declines of the last number of cyclical downturns in the property markets, we can see that the largest was 8.3%. And that was actually during the 2017-19 downturn, which was manufactured by the regulators and the banks. So I think this time it'll be more than that. However, I don't think it will be as cataclysmic as some of the commentators like to make up. And I've got some more information on that in a moment. So I think this is a really good slide, actually, because I'm just looking at things there. And let's say that housing values declined by 15%. Now, as we can see, that has a totally different impact depending on, say, these capital city markets as to which one you're in. So if you look at Sydney there, 5, 10, 15% takes you back to sort of early 2021. Brisbane, on the other hand, if you go down 5, 10, 15%, takes you back to only late last year. And then Melbourne, obviously, it didn't have the uptick that Sydney did, so they'll take you back to about April of 2017. Adelaide's still going pretty strongly now, so again, late last year, a bit like Brisbane. And Perth is quite different because Perth previously peaked 8 years ago in 2014 with the commodities boom. So a 15% decline there would certainly take that market back a long way, but I don't foresee that because it certainly didn't have that uplift from low to high watermarks.
Mm-hmm, mm-hmm.
This is something that's really interesting, and it'll come back to when we have a discussion after, Ashley. But if you look at what's happened in past cycles, after the Reserve Bank increased the official cash rate for the last time, look what happened after 1 year, after 2 years, and after 5 years to house prices. And as you can see, after 1 year, it ranged from -4% to +14%. But if you have a look at 5 years, it ranged from 26% to 64% in terms of an increase in value over time. And I think it underpins the cyclicality of growth assets in general, but certainly of this particular growth asset, which is Australian residential property. So worth bearing in mind, and I'll come to it because we like to, I guess, have clients understand that property is more the boring part of your asset portfolio, and it's not designed to be traded. It's more a lumpy asset that really you should try and pick quality assets in the first instance and keep them.
Mm-hmm.
So something we use often, and we say to people, it is as easy as pie and has nothing to do with our famous pies. It's about population growth, infrastructure growth, and employment growth. And if you choose a quality residential property in an area that has those attributes and has those growth prospects of those attributes, I think you're going to end up doing very well compared to simply buying something because you like the look of it. Another question we get a lot is, shall I buy an old property or a new property? Depends. Depends very much on your own skill sets, how much time you have, what you're trying to achieve, and whether you're able to do that. Currently, it's probably a bit difficult in terms of renovating or rebuilding or developing properties because it's hard to find labour to do so. It's also very expensive. But there are the tax benefits, which we can touch on later on, which differ between old and new.
Mm-hmm.
So when we've looked at this, and don't forget we've looked at this for the long term, typically speaking, if you're an Australian tax resident, this is what the pie looks like. So, in normal cycles, you pay for a small amount, the tax office pays for a much larger amount, and the tenant pays for the rest. So this is if the property is structured correctly and also has tax attributes that will assist you in continuing this on, not just for the first year, but for many years to come. So if we go to the next one there, Ash.
Well, just before we do, can you elucidate some of the items under the taxman? The thing that comes to mind for me first would be interest deductions on investment properties and depreciation. Would that, am I thinking of that right?
All allowable deductions in terms of, because it's an income producing asset. So it's not just interest, management costs, repairs, maintenance, all of those issues. But the big non-cash ones are obviously Division 43 and Division 40, which are the depreciation items, because you don't pay for those, but you in fact claim them. And so you get to offset all of those against your personal exertion income. So, it's actually real money that goes in there. It's just not yours.
Yeah. Okay.
So if you're an Australian expat, it's different because Generally speaking, these are all generalizations, don't forget. Generally speaking, people don't have a lot of ATI, Australian taxable income. So that may just be rent. So most of the clients that we see won't have, a property that's totally paid out, or a number of properties that are totally paid out and producing a whole lot of income, which is being taxed at non-resident rates. So they will get to save up, I suppose, those tax credits, the ones we just spoke about, that saving, and they can use that if they ever choose to sell the property to offset, the capital gains tax. But usually what we find is when people eventually repatriate to Australia, clearly they have no half-life, these credits. So they'll use that to offset against their personal exertion income, which may be, for one or a number of years, depending on how much they've built up.
Mm-hmm, mm-hmm. So you've got a P&L here projecting.
Yeah, so this is just, call it a property investment analysis report. And so for an expat here, as we can see, you're making a contribution to buying that asset, and it's a $850,000 asset that you're purchasing. The other important thing there, I think, Ash, and we didn't touch on this before, but most people tend to use leverage when they buy property. In this instance, we've got 80% leverage there. So it's important to recognize that, because the other growth asset is really shares, equities. And we don't really like our clients to employ the same amount of leverage if they're buying a mark-to-market asset, such as shares, because if there ever is any sort of sharp downturn, then quite often people don't have the spare cash to contribute to maintain that asset portfolio, and they can see all of their equity getting wiped out in terms of a margin call. So that's why, horses for courses, we like to, I guess, look at leverage more so on this front, because if your property value declined by 20% next month, you don't have to meet a margin call. So as long as you can continue to pay your monthly interest repayment, it will continue as before. Does that make sense?
Yeah, I guess that's just my nature. I like doing a deep dive into these numbers and, to see what's there. And I like the assumptions that you've used. I think they all seem quite fair. Looking at that, the rent number that you've used, I like that you've got a vacancy allowance in there, 770 times 52, take off 5%, and you get the actual number that you've used. So that makes a lot of sense to me. I like the inflation rate. I just think it's a very elegant analysis that you've done, and it speaks to exactly what you've said already. It's not so much a cash flow, or it's certainly not a cash flow positive investment, but from an expat's point of view, that's not a bad thing. Having it be not produce taxable income in Australia, given the non-resident rates. I think you see this mortgage being amortized over time, the property growing, fingers crossed, and then it produces a good return. So I think this makes a lot of sense.
Yeah, look, we try and make that, I guess, underwhelming in some respects, because it's always nice to have an outcome that's even better. So that's just to give you a bit of a quantitative view, rather than just crossing our fingers. It gives you a bit more to actually see how that should look in the future. And saving up, as you say, saving up those tax credits, it's a little bit like it's almost like a savings mechanism by default.
Right. We have a question from Mr. Jim DiCarlo. Does the summary factor in the year-to-year out-of-pocket actually cost you? Is his? I think I'm translating that correctly. I believe, Jim, what you're asking there. So is this, and maybe that's the previous slide so much. So are you writing a check to cover this after-tax cash flow? That's what I think Jim's question.
Yeah, you are. Yep.
Yeah. Okay. And then what's the difference over here in this analysis? All of a sudden,
right? Yeah, the numbers look so different, don't they?
Yeah.
So the difference here is that as an Australian tax resident, and I just used a salary of 300,000, you get to use all of those tax credits up front. Now, some people wait till the end of the tax year to put in their return. Other people simply get their tax agent to lodge a tax variation, and the tax office will write back to their employer and take out less tax on a monthly basis or whatever their pay cycle is. But as you can see in this instance here, same property, it's actually producing a positive situation of $86 a week. So that gives you the difference, I suppose, of what you're saving up if you're a non-resident, as opposed to someone who's working in Australia, living in Australia, and buying that same property now and utilising all of the legitimate deductions that property produces. But it's important because this is a new property. It is a high quality asset, so you're going to have higher depreciation amounts in both Division 43, so the building price, and in Division 40, which is the fixtures and fittings.
So just to be clear here, so the first projection, this is the same property, 701 Manning.
Yeah.
The first example, we've got the expat, which we can see over here in the top left-hand corner, and then the next, the Australian resident. That's the difference in the tax treatment. That's what you're saying. So
it's not the difference in tax treatment. It's really a difference in timing, because the expat will get all of that money when they either go back to Australia and earn an income, sell the property, or utilise it in another manner against other assets that they have there, or other income, because we actually have a lot of clients who do have a home in Australia, or they, was their home. They have paid that off, and they're now getting anywhere between like sort of 40 and 60,000 a year rent, which they're paying tax on. So they can actually use these credits to offset that tax. And that's a third example. I didn't put it up here to complicate things, but it's something I can show you, and you can show your clients in due course.
And we have a question, which I think you've already answered here, from Ryan Winter. He says, and I already know the answer, but good to hear it from you. He says, I think I missed this, but can you save up the tax credits for when you return to Australia and claim them? And if so, is there a use-by date on that?
So, Ryan, yes, you can. And there is no use-by date. So you can just save them up as you go along and utilize them when you go back, as I said, in numerous ways. The easiest one is to offset it against your personal exertion income and take up some of that, potentially tax shock when you go back.
And for my benefit, and for Jim DiCarlo's benefit in his previous question, so just to be clear, we can never be too clear on these things. From the expat to the Australian resident example, the expat has to write a check to stay current on this property and not get foreclosed on. Yep. And the Australian resident does not. They're getting a check for $86 a week.
Correct.
Okay, got it. Perfect. Thank you. Gareth Collins writes in and says, do these analyses include property management expenses?
Yes, they include all the costs of acquisition and ongoing costs of ownership. So when you have a look there at rental expenses, that includes all those things. So property management, might be body corporate costs, or otherwise insurance costs, depending if it's a freestanding property or an apartment. So that's where all of that's included.
Andrew, I wanted to pay you a compliment. Yesterday, as we were preparing for today's presentation, I thought I was being very clever when I pointed out that when you add the property value and the purchase costs minus your deposit, which is written here as investments, minus the loan amount, there's a $5,000 variance.
Yeah,
that's because of the fee that's charged. And I was like, well, that's great. It adds up. It makes sense. It reconciles. And also it shows me that, the numbers are rigorous in including the various expenses. And I think another indicator of that, Gareth, would have been with that gross rent. If you take, I'll just pull up my calculator here, 770 times 52, you get 40,040. Well, why is it that Andrew's used 38 here? Well, that's because let's do 40,000 and 40.
Well, there's 770 by 95%. Yeah.
So 38,038, spot on. So I was pleased to see that. Anne writes, do non-residents need to put down a certain percentage of the cost of the property? Great question. We're going to elaborate that on in much greater detail. We have time to do that about the expat mortgage process, but just quickly, what would your answer be to that one?
Same. It doesn't matter whether you're a surgeon in Sydney or work for whoever in the US, it's the same amount. You put down, generally speaking, if you're buying something that's brand new and out, if you're a client of ours, 15%. There are some provisos in terms of size of loan in relation to that. So 15% deposit plus stamp duty and legal costs, etc. Or if you're buying something that hasn't been constructed yet, generally in Australia, you put down 10% and the balance at completion, the other 5% plus costs.
Okay, moving right along here.
So, look, this is just something I thought I'd put up there because we do have these conversations from time to time, and I just had it with a client recently, actually 2 weeks ago. He bought something a couple of years ago and he's made 50% on this, and he said, "Oh, look, do you think I should sell it?" And I said, "Well, no," in not using quite that language, but the reality is, and if you have a look at some of these numbers, as you can see, people tend to sell things quite often for no particular reason. So if they can afford to buy this quality asset and keep it, there's generally speaking no real reason to sell it unless you have one. So we find that something could happen health-wise, or people can get divorced. But otherwise, unless you've really got a great need for that capital or a better use to put it to, you shouldn't sell it. And that comes back then to also dealing with the situation about capital gains tax, Ashley. We've got a really good way of dealing with capital gains tax. Don't sell it.
Yeah, and I thought you were going to say that.
So you're in control of that situation unless something like that happens. And certainly for this client is a younger client, and he works in financial markets and sits in front of screens. Everything's a trading situation, but do that with other assets, do that with equities, or do that with bonds, but don't do it with property.
I think that's the last slide that we have here.
I did have a couple of others, and I can do that afterwards. I can let's go through our thing, and I can show a couple of slides that you asked for later on because I have them in my slide deck.
Great. Yeah.
Let's go through some of the questions that you wanted to ask me. And,
thank you for that. So, as a non-resident, tell me what do I need to be aware of? I mean, broadly, what are the differences between buying as a non-resident versus an Australian resident?
Right. So, look, fundamentally speaking, there are no differences. It depends very much in relation to what you're trying to achieve. And certainly for all of our clients, we're saying, look, add property as part of your overall asset pool, and try and develop that as you go along. As you well know, if you are an expat, quite often you're going to be earning a higher income than you may well be earning in Australia. You may have greater opportunity to utilize some of that income to increase your wealth base. And if you're away for 5, 10, 15, 20 years, as we see a lot of expats are, if you make use of that time and not perhaps use that extra money wholly and solely to improve lifestyle or discretionary expenditures, you can come back and have quite a large asset pool that really hasn't impacted you along the way. And that's what we find with clients. So there's no real difference as such, as long as you can afford to do everything comfortably. Don't cause yourself any anxiety, obviously, but the hardest part is trying to actually get it all done, because like I said, most people are pretty busy, whether that's work or kids, the whole thing. So it's difficult enough, and we find that a lot of our clients obviously all started off being in Australia. You speak to your typical medical specialist or lawyer or banker, they haven't got time to do a lot of the things that you need to do to actually end up with that good outcome.
Well, implicit in what you're talking about is the mortgage underwriting process, and surely there's some big differences with how that works from overseas. What do they do to offset your income to handle that foreign currency fluctuation? Because surely that's a risk facing the banks.
Yeah, absolutely. And that's, I guess, where the biggest differences come to play. And I look, a lot of lenders are fairly savage on us, on Australian expats living abroad and earning foreign income. So generally speaking, there is a provision for currency fluctuation. A lot of lenders will take off 20% of our earnings, shaded by 20% to come up with a net figure there. Now, that can work quite well, but then a lot of the banks will say, well, hang on, you're eventually going to come back to Australia, so we're going to pretend to tax you at Australian rates now when we're determining how much we're going to lend you. Now, that's many and varied. So if you're living in the States, in the US, tax rates are not that dissimilar to Australia. But say you're living in Dubai or Singapore or Hong Kong, where tax rates are massively dissimilar, then it can become a real issue for those people. So again, it's horses for courses, but we try and obviously assist and overcome. And I've had conversations with credit at various banks over many, many years, and we do make progress with that over time. So as I said, now we have a situation where, certainly on the upfront cash that you need to put in, that's a big benefit for our clients. It enables you to get into your first property that way, or potentially build up that property portfolio a lot more easily, because if you look back and look over the last, say, 4 or 5 years, most people have had a fairly significant uplift in the equity in those properties that they've either owned or bought, and they can now use a portion of that to increase their portfolio, or they can put in a small amount of cash if they so choose.
Just building on your point there about underwriting, do the underwriting guidelines differ on a country by country basis? So would they look at an Australian in the US and say, oh, well, the taxes there are, if you're in California or New York, are similar. Your income, the strength of the dollar is what it is currently, so maybe we should give it an offset for that. Is it done on a country by country basis? Because the way I heard you say just now is the applicant should expect to I heard it differently. It sounded like it was the burden was put on the applicant rather than the underwriter, the bank itself.
No, the bank itself. So credit policy is set by the banks, and they will generally not set that on a country by country basis, but it will have, in certain instances, a country by country impact. Because let's say you're in the States, and say you're living in New York, so you're similar to, an Aussie paying Aussie tax in Sydney. The bank says, we're going to tax you at Aussie rates. You go, well, you know what? That doesn't make much difference. I'm pretty much on the same rate. Now, let's say you're living in Dubai. That's a big difference, because they're going to pretend to tax you at Aussie rates when you're not paying any tax.
But that's not the only offset, right? Like they'll do a 20% of your...
No, that's got nothing to do with the offset. That's on top of that. The offset's only for currency fluctuation.
Okay. And
so some banks will only do that, and then there's nothing more. Whereas other banks will say, okay, we also have that tax scenario. So you'll find that, say you are living in Dubai, you may think you can borrow a lot more money than you actually can. For most of our US-based clients, as I was saying, it's not really a massive predicament at all.
Yeah, okay. All right. Talk to us about capital gains tax. That's one thing that's given me pause about buying real estate as a non-resident, is you're thrown into these very high rates for the period of time that you're a non-resident. Even if you come back to Australia, then the time period where you were a non-resident is then prorated at non-resident rate. So that's always slowed me down. Andrew, talk me out of that. Why am I thinking of that?
Look, I don't want to talk you out of it, because we've got a hell of a lot of clients around the world that just want assistance with this. And so we don't try and talk anyone into something or out of it. The reality is, you should ask yourself the question, if I bought something 10 years ago, and I have it now and I have the ability to sell it, but I don't need to, where would I be from a capital gains tax viewpoint, as opposed to not having that asset? Because that's generally what I find that happens. People just don't accumulate those assets. And I'll spend a couple of minutes on this, because it's certainly an issue that doesn't really bear too much thought for many reasons. One of them is, as I say, why sell the property and incur capital gains tax in the first instance, unless you need to? Secondly, you're not paying extra taxes as such. You're paying the normal tax. In Australia, you get a capital gains tax discount. So now if you've owned a property, and you've had it for some time, so obviously before May 2012, that's not the case. After that point in time, that will be the case, that you don't get the capital gains tax discount. And this is where it's so important to get some advice. So none of our clients are really going to face that problem until they have 6 or more properties, because the ones that we choose for them have, as I said, all of these inbuilt deductions that are non-cash through depreciation. So you go and sell your property, Ash, and as long as we've found the right one for you, you're not really going to have any physical capital gains tax to pay, I would suggest, after you use your credits.
So, and that's a good, I like the answer to that. I like it in part. I don't like it in whole, but that's because I'm trying to get the biggest bite of the cherry for my clients as possible. And that is, and we have to balance those things. Let me ask a question. In the US, there's such a thing as what's called a 1031 tax-free exchange of property. I've never heard of it before in Australia, but
it doesn't exist. That's why I haven't heard of it.
Okay. Thank you. That's what I
Makes it really simple. Yeah.
We've got a question here. Just sorry, were you going to say something more there?
No. I'm as I'm saying. I think. Gosh, how can I put it? You never go broke making a profit. So you've got to look at things, and sometimes you can put the horse before the cart. So you saw that slide in terms of nominal hold periods or generalized nominal hold periods, and how long you should be holding an asset for. If you're going to be, if you hold that property for 20 years and you're going to be paying the normal capital gains rate on 6 years of that, gosh, you'd be a really lucky person.
We've got a question here from Scott. Scott's an American living in Sydney for the past 15 years, just about. It's his understanding that you must take depreciation in the year or lose it. You cannot defer it and elect to take it in a year that benefits you. Same for any other property losses.
That's unfortunately just not correct. Or fortunately, that's just not correct. There's no half-life on that. You put in your tax return and you claim it. And if you're in a negative position, you can carry that forward as long as you like.
Yeah, I didn't quite know what to make of that question either. It's like it's just part of an annual tax return, and
correct. That's right. Yep.
You either benefit from it or you don't. It's simple as that.
So if you that's the difference in those two cash flows. So if you have the income to offset it against in that year, you can. But if you haven't, you simply carry it forward.
Right. Daniel asks, is there any concept in Australia of what's called depreciation recapture when someone sells a property? This is an issue in the US. Are you familiar with depreciation recapture, or do you want me to?
No, please go ahead. Yeah.
The idea with depreciation recapture is that if a property has been depreciated or when the property sells, if it's shown that the depreciation schedule that applies was not appropriate, meaning there was more of a gain on the property, the fixtures, the improvement and the fixtures that were depreciated, then that gain that's attributed to the fixtures and the improvement is recaptured. It's depreciation recaptured. So you took a depreciation that you weren't entitled to, and that's the idea. And it's taxed at 28% at a federal level.
All right, so I can answer that one for you. So what we do in Australia is we get a quantity surveyor to prepare a depreciation schedule. These are licensed surveyors. They will do that, and the tax office accepts that as a schedule of depreciation that the taxpayer will then lodge every year when he puts his return in through his tax agent. And similarly, that also goes for Division 43, which is the cost of the building. So you get to depreciate the entire cost of a new dwelling over 40 years at 2.5% per annum. So you won't get the situation of this capture because it won't exist. You'll have depreciated the correct amount over that period of time.
Okay. I think that answers it pretty conclusively. No need to cross-examine you on that one, because it just doesn't sound like, like a 1031 just doesn't sound like it's a thing. We've got Scott with his hand up here. I'm going to just allow him to talk.
Yeah.
Scott wants to jump in and ask
Hey
his
guys,
question.
you can hear me. Hey, it's Scott in Sydney.
Hey,
Yeah,
Scott.
I was just writing back clarifying. I did agree with what you said. Initially, you said you could choose the year you wanted to take the losses, but you have to carry them forward and then you can use them down the road. Yes.
Yeah. Yeah. So when I say choose, I mean, yeah, when you're enabled to. So, these
I
are
asked my
losses.
accountant, here once if I could choose the year in which I could take my expenses, and he told me no. He said
No,
they
the expenses are
they had to be
incurred
taken
when they're
in the
incurred.
year incurred. Yes, that
Yeah.
was the point. Sorry.
I get it. Yeah, I
but
get it.
yeah. And we've got a comment here from Jim DiCarlo. The Aussie model makes the US look like the Wild West sometimes. Yeah, point taken. It's in Australia, it's principle. This is the way that I've heard it described before. Is it's principles based, not rules based. And with rules, you can have contradicting and overlapping rules. In Australia, it's just plain principles. Here's how this should work. We don't care what you call it exactly. This is the principle under which how something should operate.
It's actually quite nice because it gives you a certain amount of, peace of mind and certainty going forward. So that's why I'm saying on this boring part of your asset pie, that's nice to have. You don't need to spin the wheels too much.
So Andrew, a lot of clients that I work with will say to me, gosh, I want to buy a property back in Australia to quote unquote land bank that. I don't want to be priced out by the time I move back. Where I've had difficulty with acting on that is twofold. One of which is it seems over the long term, well, not seems, it's stocks have certainly outperformed real estate over the long term. So that's kind of my first answer to that. But secondly, the investment objectives don't necessarily align. If you're talking about owning a property as an investment, that may not align with owning it as a personal residence. But so how do you answer a client who came to you?
Well,
with
I'll answer
that
your first question first. Whilst equities, don't forget, I'm an equities guy, by the way. I just learned over time that, sometimes you can create a lot more heat than light. So whilst equities outperform property in the long run, if you geared your equities portfolio to 80%, the same as your property portfolio, you'd be broke because most people don't have the cash to meet margin calls. And as we also know, due to the cyclicality of these asset classes, you would then have to try and time the market and get in and out all the way along to meet that. So it's difficult. So I think you've got to understand that first. You've got to say, look, I want to invest in growth assets. Okay, I'll do that with equities, but I may not employ any leverage or a large amount of leverage. Whereas in property, I can afford to maximize my leverage to maximize my end return. So let's say I've got 200,000 and I invest that in equities for the next 10 or 20 years, or I take the 200,000 and I buy $1 million property and keep that for 10 or 20 years. I think you'll find your outcome may be different to what you think, if you look at it just in terms of notional amounts. That's the first part.
Yeah, it depends on the broker that you use. You'll find that the lowest interest rate out there is with interactive brokers, and they will do loan to valuation.
I'm not talking about
ratio.
interest rate, Ash. I'm talking about the capital value. So if you've got $1 million share portfolio, and you have as we've had this year, let's say, call it even a 15% decline, you may find, you will find that mostly they'll allow you, say, maximum 80% leverage against those assets. If you don't have the money to tip in to maintain your LVR, you'll get sold up. As to whether that's the whole lot or part, but it can sometimes be all of your equity or certainly a major portion of it. And that's where I think if you did some modeling for yourself, I think it's really useful because we've done it for clients in the past, and just look at those two scenarios, you'll find that you'll probably be able to model your overall asset pie and get ahead even further if you use this leverage intelligently.
Okay.
So that's the sort of mechanics of the actual numbers. And then the second thing is, of course, yes, I mean, if people, and we get this, people say, look, I want to live somewhere. Then I go, well, when do you intend to do that? Well, I'm not really sure. It could be in a couple of years, but look, it could be in 5. It's really hard, I think, to try and choose something that's going to be your ideal place to live in, 5 to 10 years out, because you may change your mind. So I think you need to then delineate that and say, either I'm going to buy investments to buy that asset in that market so that I'm in the market, rather than potentially my home. But, hey, everyone's different with that.
Okay, so Julie writes, does inheritance of real estate work the same in Australia as the US? Well, firstly, I'd say, Julie, go check out our Q3 webinars, where that's precisely what we looked at for 3 different webinars with a cross-border CPA. Do you mark the basis to market when you inherit a property? We're all dual Australian and US citizens who live and work in the US currently. Well, I think that's different. That's already been answered. It's a very complicated question, actually. So I'll just say go have a look at those webinars. And I will have 3 kids attending uni in Sydney. I'm thinking that buying a unit may be a good option versus paying 3 times rent. My husband and I would then retire there. Is this investment something your company could assist with negotiating? Please disregard if question is too specific.
I can throw in a couple of things there. I suppose having 5 children, yes, it probably is a good idea not to pay 3 rents. But on the flip side of that, if you look at the actual, human nature impacts of that, I doubt whether 3 of my kids would want to live in the same place together. And what also tends to happen is that quite often, they may have meet a girlfriend or boyfriend that lives on the other side of town or wherever. And you might find yourself with an asset that's really been designed to help your children, rather than just being an investment. So take that, I suppose, with a grain of salt and just see what the best outcome is, because sometimes perhaps paying the 3 rents may be more flexible.
Mr. Jim DiCarlo writes, are people like an American buyer, for instance, who are the target audience for today's presentation, using tools like Airbnb today, and can that work? What are your thoughts about Airbnb?
Yeah, look, I think, given what's happened, especially since the end of the pandemic and the borders have opened, I mean, there is a massive undersupply of both short and long-term rental accommodation in the major markets within Australia, certainly on the eastern seaboard. So Airbnb can work if you have the right, if you buy the right properties. And it can work quite well. Depends a lot on, what your profession is, or where you work, how much spare time you have, because clearly, even though someone manages that, it's a lot more labor intensive or hands-on than if you have just a normal higher quality tenant that lives there and renews their lease for, say, 12 months at a time. So, but yeah, very, very, very usable.
That's a good segue right there. Advice on handling property management from abroad. Do you guys offer any assistance with that?
Look, if we choose the properties, they're in certain areas where obviously we'll look for what we can find as the best quality sort of property managers, and they're not easy to find. So if we do, we certainly pass any of those things on to our clients. It's all totally transparent. There are no other fees or anything that we receive from any adjunct sources. But yeah, we help clients with that, because that's something we find is a major bugbear for people. So if they make, if clients have, say, one old property somewhere and they have it managed by the local real estate agent, it becomes a very tedious process, because quite often older properties can have lots of repairs and maintenance issues, and you find the property owner has to deal with the agent or the tenant or both, and we get those sort of horror stories, whereas the opposite is clearly very pleasing. Some people, people would generally like to have no input, but that's impossible. But if it's a very light touch one, we find that to be sort of the, I guess, the ultimate goal for them, and people love that.
The last prepared question I had for you, and I think this is a good one to really get clear in people's minds when they would reach out to you as opposed to when they might do it themselves or look for another service, that would be, what would be the advantages of working with your firm versus something like a realestate.com.au or domain.com.au?
So, and it's a great question because, again, people think of these names now. Realestate.com.au is a great company, a great business, but it's not a service. It's a platform, as is Domain. So, and they're the two most widely used online platforms where vendors or real estate agents advertise their properties for sale. So, and they're great. I think they're really good. I always get people to have a look at those so they can do a little bit of, market due diligence themselves if they have the time. I think that's really helpful, but that's what they are. They're a marketplace, so they're not doing anything to assist you. What we find, generally speaking, is, and it comes back to the loans. In fact, I was speaking to someone who's American, but his wife's Australian, and they're just in the process of buying something in Australia. And he said to me, I was given your name by a friend because I'm being quoted a very high interest rate. And I said, well, look, let me have a look at the proposal. And he sent it through and I had a look and I said, well, we can shave 80 basis points off that for you, by the way, with the same lender. And he said, how's that possible? So because foreign income borrowers, mortgages are far more specialised, a lot of brokers in Australia might only do one every now and then, or perhaps haven't done one before at all. So, you really have to know the nuances of each lender and how they process things to package that loan in the right way so that your client actually gets the maximum benefit. Now, 80 basis points on $1 million loan, $8,000 a year. I mean, you can see that someone's getting quite a bit of value out of that. And I end up just doing it for this person because he was a friend of someone that I know. But, generally speaking, those are sort of things that we find you can add a great deal of benefit up front and also get people's expectations correct so that they know before they go out and look how much they can potentially spend.
Mm-hmm.
Because some people just go onto a website from a bank and put in the numbers and think that that's it. Well, it's very different for, as I say, expats rather than people living within Australia.
Fantastic. Well, thank you so much for your time, Dr. Andrew Unterweger. If folks wanted to reach out and make contact with you, how would they best do that?
Well, I think it's best if they just go through you, Ashley. I mean, you've got all of our contact details there, and happy to speak to anyone or give them some information. But I think ideally, if they go through you first and you send that to us, then that's the right point of contact.
Okay, well, thank you very much. So if you do want to learn more, if what I had mentioned previously does sound like your situation or someone that you know or care about situation, then do feel free to reach out, come to our website, click on the Get Started. It'll give you a brief run through of who it is that we work with, the kinds of issues that we specialize in assisting our clients with. If you're after a little bit more information, remember today's webinar will be posted to our YouTube channel. We notify all attendees, registrants, that the webinar has been posted. I should also, this is a great call out for Dr. Andrew Unterweger's channel as well. What he provided today in terms of an update is actually a great summary of the detailed quarterly update that he does. So there's a 90-minute state-by-state update that he provides. So you can go have a look for that on his YouTube channel. And then other than that, I think we have one more. Nope, it's a thank you. Thank you, Jim. Thank you to everyone. And most of all, thank you to you, Dr. Andrew Unterweger. Thank you very much. And
thank you, Ashley. Thank you, Jim. Thank you, everyone who was on the call. I hope you enjoyed it.
Indeed. All right. Have a wonderful rest of your day, everyone. Thank you so much. Bye-bye.